Good evening, everybody, and welcome along to this presentation brought to you by ATFX in association with Trade with Precision. My name's Chloe, I'm with Trade with Precision, and I am very happy to be spending an hour talking to you about trend trading versus counter trend trading. Which should you choose and why? So before we get started, I would just like to give you guys an opportunity to have a quick look at the following disclaimer slides. Just need you to have take a couple of moments to read through these, make sure you agree with everything therein before we continue. Also, feel free to introduce yourselves. Let me know what your experience is with trading, whether you're new to trading or you're an experienced trader. I'd love to hear from you. As the second risk warning slide there, so just take a couple of moments to have a look through that, and then we can get started with the presentation. Hi Danil, hi Soki. Fantastic to have you along. Okay, that should be enough time, I think, to read through those, so we can get started. So today's agenda, we are going to talk about trend analysis is an important part of trading. We're going to look at how to spot trends, and then we're going to have a look at a live market scan to illustrate the learning from the webinar. So to start off then, the fundamental decision of which direction should we be trading in? Now, at Trade with Precision, we are technical traders. We use technical analysis to base our trades on, and our technical analysis gives us a bias in the market, and we trade in that direction. There are sometimes things fundamentally that we can take into account when picking a trend direction. But overall, what we are looking for is technical analysis, and that is what we base our decision of which direction to trade in. So trend analysis is a really important part of trading because it gives us an idea of the market flow. It gives us an idea of who is in charge of the market, whether that's the buyers or the sellers. And of course, what we want to be doing is trading in the same direction as the market flow, the same direction as the majority of others are trading in, and that weight to our trades. And we're more likely to pick winning trades if we're trading with the overall market flow at any one time. So trend analysis is extremely important for that because it does help us to work out what the market direction is and therefore which direction to trade in. So let's have a look now at how to spot trends. And I'm actually going to take you through to the ATFX platform, so bear with me while I get that up for you. So here we have the ATFX MT4 platform, and I'm now going to take you through how to spot trends and trend analysis. So of course I have here a chart of Kiwi Swiss. It doesn't really matter which chart we look at. Let me find, yeah, this one will be fine. So how to spot trends? The first that I'm looking for is I'm looking to identify my highs and my lows in the market. If you've been trading for a while, you will know that the market doesn't move in a straight line. The market may flow from bottom to top or top to bottom, but it doesn't move in a straight line. What we tend to see is we tend to see cycles, we tend to see waves in price action where price goes with the trend and then it moves back against the trend. So it moves with the trend and then against the trend, with the trend, against the trend, with the trend, against the trend. So the market doesn't move in a straight line, but the first thing that we can do when we're looking at any chart is we can have a look to see, is the chart moving from bottom left to top right, in which case that's likely to be an uptrend, or is it moving from top left to bottom right, in which case that's likely to be a downtrend. Now, in this case here, we have the chart moving from top left to bottom right. So that tends to signify that we may be looking at a downtrend. As I mentioned, and from that, we can start to identify highs and lows. So if we look just at this trending part of the market here from around this point onwards, so this is the highest point here. Excuse my drawing, but I'm sure you get the general idea. Then the market moves downwards to a low point, and then it moves upwards to a high point. So this is a low. This is our next high. So from here to here, this high is lower than this one. High number 2 is lower than high number 1. Then price moves down here and then gives us a high. So this is our low here. So low number 1, low number 2. Low number 2 is lower than low number 1. So what we've got here is a lower high and a lower low. And what we're looking for when we're looking at trend analysis is we're looking for a series of lower highs and lower lows for a downtrend. And we're looking for a series of higher highs and higher lows for an uptrend. So if I just draw this for you now, a basic downtrend would be a series of lower highs a basic uptrend would be a series of higher lows and higher highs. So that's the basic definition of a downtrend and an uptrend. Now, obviously, we don't always get picture perfect trends, but once we learn to identify and analyze the lows and the highs, then we can start to determine whether we've got lower highs and lower lows or higher highs and higher lows. So this is a really nice downtrend actually. We've got a series of lower highs and lower lows. It starts to get a little bit messy around here. What we have here is the same high and the same low. So this area here is actually not trending, it's actually ranging. But overall, the market is trending down, and we finally get another lower high and lower low. So that is the definition of a downtrend, and that's what we're looking for in a downtrending market. At this point here at the end, what we actually have is we actually have a higher low and a higher high. So at this point here, the trend has actually changed, and we have higher low, higher high. This is the beginning of a potential uptrend here. We don't know what's going to happen in the future, but at the moment we have a higher low and a higher high, so it's the beginning of a potential uptrend. Let me get rid of my scribblings. So another thing that we can do to help us in our trend analysis is we can add some indicators onto the chart, and I'm just going to add a couple of moving averages. So I'm going to add my 50-period moving average, and I'm going to add my 20-period moving average. I'm actually just going to use those two for now. Actually, I'll add one more. And it's going to be the 10 moving average. So moving averages also help us to identify trends, because moving averages okay, sorry, I've just had a question here from Christopher. Thank you for the question, Christopher. And yes, I do encourage you to ask questions, by the way. That's exactly what I'm here for. So any is, as a rule of thumb, am I looking for a certain number of higher highs and higher lows to feel confident of the trend? It's a really good question, Christopher, and the answer to the question is no, actually, I'm not. If I'm talking about taking a trade, I have a strategy in place whereby once I have analyzed the trend, I then look for, or I then overlay my strategy, and I'm looking for specific things in order to enter a trade. But in terms of analyzing the trend, all I need to see is higher high, higher low, or lower high, lower low. Higher high, higher low for an uptrend, lower high, lower low for a down. I don't need to see 2 or 3 successive higher highs or anything like that. It's just the one higher high and higher low that I need to see. Back to moving averages. Moving averages, they simply average out the price over the past X number of bars. So the 50 moving average is the average of price over the last 50 bars. The 20 moving average is the average of price over the last 20 bars. And the 10 moving average over the last 10 bars. So it averages out the price, and therefore, if we can see a clear direction that the moving averages are going in, then that is going to help us identify the trend as well. The moving averages pointing downwards helps us identify a downtrend. If the moving averages were pointing upwards, that would help us identify an uptrend. And in addition to that, if we have several moving averages of different lengths, then what we're looking for is we're looking for those to be in the correct order. So here, to have a downtrend, we have the 10 moving average at the bottom, the 20 above that, and the 50 above that. And they're all pointing downwards, and that gives us confidence that we are actually in a downtrend. Now you'll notice here at the end, I have a higher low and I have a higher high. So back to your question, Christopher. In terms of identifying the trend here based on higher lows and higher highs, I have an uptrend here based on higher lows and higher highs. I have one higher low and one higher high. That is all I'm looking for in order to identify that trend. However, in terms of actually taking a trade, I wouldn't necessarily be just pressing buy at this point. I would be waiting for added confirmation based on perhaps my moving averages, and I would be waiting for all of those moving averages to be pointing upwards and in the correct order. So I would be waiting for the I would be waiting for the 10 to get above the 50, the 20 to get above the 50. So my moving averages would look more like that. And that is an additional we're always looking for confirmation. We don't want to just jump in based on what we think. We want to have confirmation based on what we see. So those are the main things that I use to spot trends. It's mainly the pure price action, the highs and lows in price, but I also use moving averages to help. Let me see if I can find an uptrend for you so that we can compare. So looking at this second half of the chart, we can see an uptrend here. So again, we're looking at higher highs, higher moving averages, which are all pointing in that direction also. Okay, so another question, how would we know when to place a trade in case it begins to go up? Good question as well. All I can say to that is I trade using a strategy. So I have a set checklist of things that I'm waiting for before I place a trade. So I'm always analyzing the trend first and foremost. I'm waiting for confirmation, and then there's certain things that I will be waiting for in order to place a trade. So it's certainly not a case of being afraid of missing something in case it goes up. That's not how I would that's not how I would. Sorry, I'm just trying to find that question again. It's not a case of placing a trade in case price begins to go up. It's a case of waiting for price to go up and waiting for confirmation that price is going to go up and then placing a trade. So we don't want to be guessing that price might be about to go up and placing a trade. We want to be waiting for confirmation. I'm going to get a little bit more into that because what we're talking about really is the difference between trend trading and counter trend trading and why I prefer one over the other. So I'm gonna, while I'm on this chart I'm going to use this as an example. So if we just take a look at what we see on the chart here, what we've got is we've got a level of horizontal resistance here, which I've drawn in as the red line. So we can see resistance, resistance, resistance. Price has struggled to get through there. It's been support in the past also over here. So in terms of what I might want to do with my trading, we can see this uptrend here. And we've got this horizontal level here. and price has reached that horizontal level. Now, a lot of counter trend traders would be looking to sell at this point. They'd be looking to sell at this point in the anticipation that price may bounce at this price would bounce at the horizontal level and go down. However, how far it's going to go down is anyone's guess, really. We just don't know how far it's going to go down. So it's all well and good pressing sell up here, but where would your target be? And if we then take a look at what actually happened, price continued with the uptrend for a significant amount of time longer. So what's happened is price has gone down from this point here, but we still have an uptrend intact. Price has ended up breaking through that level, coming up, coming down again, and continuing the uptrend. So in my opinion, it's actually much easier to trade with the trend, because if we see from this point here, we've got a higher low, and past this point we've got a higher high. So here we have a trend, even an uptrend. Even if we wait for confirmation of price to get above these moving averages, we still have a lot of trend left. So even if we waited till this point, we then have multiple opportunities to buy this market. Multiple opportunities to buy this market. No matter what your strategy is, if you're looking to buy with the uptrend, there will be multiple opportunities across several different time frames, most likely. Whereas if you're looking to counter trend trade and sell the market, you might try and sell here. You might make a little bit of. If you had waited, if you were looking to buy here, buy here, buy here, and buy here, you've got all of this profit to make as price goes up. Whereas if you're looking to sell as a counter trend trade, you really don't get quite so much opportunity. You certainly don't get such high reward to risk trades. So if we look at if, for example, we were to buy down here somewhere, we would take all of that profit. Whereas if we were to sell here, we only have a little bit of profit. Buy here, lots of profit, not so much profit. Buy here, loads of profit. So trading with the trend, I believe, is much safer, because you're trading with the overall probability of the market continuing to go up. The market flow is upwards. The majority of people are buying in this market, and what you want to do is go with the majority. So that's the first thing, is you've got a higher probability of success if you trade in the direction of the overall market flow. And the other thing is the reward to risk, how much you risk on your trade versus how much you stand to win on the trade. So how many pips your stop loss is versus how many pips your target could be tends to be higher when you trade with the trend. Now, there is an exception to that, and that is if you've got if you do hit a counter trend trade from a horizontal level and price does end up coming all the way back down to the bottom of the range or the bottom of that trend, then you can sometimes pick up a very high reward to risk trade. But they are very, very few and far between. They're very low probability trades. Whereas trading with the trend, you tend to have high probability trades and you tend to get high reward to risk. Whereas counter trend trading, Yes, you can pick up this move against the trend, but the chances are it'll be a small move before price returns in the direction of the trend. So higher probability opportunities. More opportunities, I think, because if you get a trend, the trend will always go on longer than you might imagine and you might anticipate. And therefore, if you just buy at the lows as the trend goes on, there's lots of opportunities, lots and lots of opportunities. Whereas selling at the highs, harder to get those opportunities, and the opportunities that are profitable are much fewer and further between. Good question, Soki. Thank you for that. And the question is this approach of trend trading suited to a daily strategy, or can it be used on hourly trades or any other time frames? Absolutely brilliant question, and absolutely yes, it can be used on hourly trades or any other time frame. So I just happen to be looking at the daily time frame at the moment for simplicity, but absolutely I trend trade on the daily time frame and the 4-hourly and hourly time frame. Trend trading can be done on any time frame, really. And that was going to be another point, actually, because some people do find it quite frustrating sometimes because markets don't actually trend all of the time. In fact, markets trend, I think, something like 30% of the time. And the rest of the time, they're just ranging or not trending at all. And so people can find that frustrating and they can get impatient waiting for their next trade if they're waiting for the market to begin trending again once it has gone into consolidation or ranging. And the fact that we can trade the trend on not just the daily time frame but several other time frames means that we can pick up more opportunities. So just to find more opportunities, it doesn't mean that we have to counter trend trade. It just means that we can go down to a lower time frame and pick up more opportunities on a lower time frame. Another question here, would I trade at all during a ranging period? That is also a really good question. And the answer is yes, I might. And that comes back down to, let me go to euro dollar. So I'm going to take this little period of time. It's just a range that I know exists. So that seems to be the easiest thing to demonstrate. So this period of time here, so between these, I'm going to draw the highs in here and the lows I will put down there. So that's what I'm going to call my range. What I have is, compared to this here where I have clear lower highs all the way down here and clear lower lows. So yes, we're going all the way back to 2014, but just to demonstrate, that is a really clear, clean downtrend. This is the weekly time frame I've got up here. So in terms of finding trading opportunities on the daily time frame or on any of the lower time frames, there would have been loads and loads of opportunities to trade that short. But what I'm looking at now is I'm looking at the range. So from these highs here and these lows here, what's happened is I've stopped seeing lower highs and lower lows. I've started to see higher lows and higher highs. Then I've got another lower high, I've got the same low there, a spike, but pretty much the same high all the way. Trend develop. I've got a couple of higher lows there, but then I get to this high again and I get lower highs, lower lows, I get to this low again. So within this range, basically my high limits up here, my low limits down here. And because I don't have a series of higher highs and higher lows or lower highs and lower lows, I can call this a range between the highs up here and the lows down here. Now, having said that, what I'm looking at here is I'm looking at the weekly time frame. Let me draw in some lines just to demonstrate that range. So the range in question is between 8th of March 2015 and 9th of July 2017. So that is pretty much 2 years of ranging for the euro. Now, if we were to completely say, I'm not going to trade any ranging markets at all, then that would really mean that that is not what I do in this case, because what we've got here is we've got this range from the top to the bottom is 800, nearly 900 pips. So it's definitely going to be possible to make money within that. So what I'm going to do now is I'm going to go down to the daily time frame. There you can see the really nice long downtrend, loads of opportunities to sell with the downtrend there. And then here is where we start to see all of that ranging price action. Now, it's a lot harder to make money when we have a range rather than a trend. I mean, you could literally just press sell and make money anywhere along that previous trend. It's so easy. I'd love for you guys to I'd love for you guys to start trend trading, because really when you get a nice trend, it is just so delightful to be just taking every opportunity to sell the market. You can sell and take profit, sell and take profit, or you can sell and hold, trail your stop loss. There's so many different ways of trading with the trend, but really super high probability, super profitable trades if you get them in the right place with the right timing. So anyway, within this, I'm on a daily time frame here, and within this range, I can see some areas where there are higher lows and higher highs. Up here, for example, let me see where I am. Not quite sure what's seem to have lost a chunk of data there, so I'm not going to be able to demonstrate that after all, which is a shame. The point I'm trying to make really is that within this range, there are actually periods of time where we do see trend. So even though we've got the lows down here and the highs up here, and we've got a range, but within that period of time there, which is a month and a half or something, if we were to go down to a lower time frame, we would actually see trend within that. So it would actually be possible to trade within the range, still trading the trend, but just on a lower time frame. So hopefully that answers the question adequately. The question was, just to remind what that tangent was. So the question was, would I trade at all during a ranging period? So the answer is yes. If I can see a trend within that range on a lower time frame, then yes, I will trade, and I'll just be extra cautious of any horizontal levels that I'm approaching. So once I get to the top of the range, obviously I'd be cautious, and once I get to the bottom of the range. But you can also see how once we do finally break out of that range, which is just coming up here, we then see, so just around there, we break out, and we then see the start of an uptrend, which we can then trade. So plenty more buying opportunities there. Moving averages I'm using are the 50, the 20, and the 10 moving averages. Yes, absolutely. Yeah, so starting on higher time frames when we're looking for the trend, and then working down to see if there are trends within the range. Absolutely perfect. Okay, so what I wanted to demonstrate was, let me have a look for something that has given us some really nice, here we go. So I'm just going to look at Aussie dollar because it has been trending very recently. So Aussie dollar on the daily time frame, we have got a trend here, lower highs, lower lows. So there's my downtrend on Aussie dollar. Now, a lot of people tend to, I think most of the traders that I know who counter trend trade are those who get impatient with waiting for trends to develop or waiting for retracements within the trend so that they can find opportunities, and they get itchy fingers and they start looking for trades that aren't in the direction of the trend. But for me, I just find that patience is key to this, and if we are patient, then we can find plenty of opportunities. So with this downtrend here, there's a couple of things. We've got a horizontal level down here, and what we had was we had price coming down strongly, breaking through that horizontal level, and then coming back up to retest that horizontal level. So from that point onwards, that was a really nice place to start trading short with the trend. And we could have done that on any time frame. So this is the 4 hourly time frame here. Plenty of opportunities to trade short with the trend. Now, can you make money if you buy this market? Yes, you can. I'm not saying that it's impossible, but if we're looking at selling this market, we certainly get the longer moves. So once we've had price break through this horizontal level and retrace and retest, Then we're looking for an area to sell around here. And once we do that, price moves to the downside. Even if we take profit around here, we're going to make a nice profit. But we can take another opportunity to sell here and make more profit, or we can simply hold the original trade here and make a really nice big profit. The other thing that we can do is we can add to positions. Once our initial position is in profit and safe, so we've moved our stop loss to safety, we can start to add to positions, and that is much easier with trend trading than counter trend trading. So by adding to positions, what we're doing is we may enter a trade here at, say, 1% risk of our account. And let's say when price moves down to here, we've made a 3-to-1 reward to risk. So that would be a 3% gain. Then price retraces and we get another opportunity to enter. So let's say we enter again up here. Because at break even, and our second trade we enter at another 1% risk. So we've got 1% here, 1% here. So that means that when price goes all the way down to here, instead of making 3% return, or let's say we would make maybe 5% return, we're actually doubling up on the position. So we would actually make something more like 10, even more than 10% return on that, because we've doubled up on the position without doubling up on our risk, because of the fact that as price moves, we're able to get in to the trade again because we're trading with the overall trend. We could get in again here, and then we'd make more like 15 or even 20% out of this move. And again, the reason we can get in here is because we have been trading with the overall direction of the trend. If we were to be trading against the trend, we would literally just be buying here and selling here, buying here, selling here. So there's no opportunity actually to scale in and build on swing positions in that way. So that's another benefit of trading with the trend, is the opportunity to scale in and really build up much bigger positions in that right direction. Okay, a couple of other questions. Would I always use the moving averages 10, 20, and 50? And would I prefer a retracement back to the 20 moving average? My answer to you is yes, I actually do always use the 10, 20, and 50 moving averages. I don't think it really matters which moving averages you use. Just find something that works for you and stick to it. But I do always use the 10, 20, and 50 moving averages, often the 200 moving average as well. Good question. Very good question indeed. So if, for example, I had got into a sell position here, what I would be looking for is I would be looking for my major highs, which are here, and I'd be looking for my major lows. Because I'm trading with the trend, and my definition of a trend is lower highs and lower lows. Therefore, to come out of a trade, what I need to see is I need to see that that trend has changed. So I need to start to see higher lows and higher highs. So once I get to some situation like this, where I can see that the lows are struggling and I'm also starting to see higher highs. This to me actually is a bit more like a range, but it is an indication that I might want to start thinking about coming out of the trade because I'm starting to see higher lows and higher highs. So that's one thing that I can do. The other thing that I can do is simply trail my stop. So my stop at the highs, then eventually price will simply take me out of the trade as I hit my stop loss for a profit. One can use indicators for divergence, so momentum indicators such as RSI or MACD. I do know a lot of people who use those for divergence, and that could be an indication that a trend is coming to an end, and therefore you might want to get out of your trending positions. So we at Trade with Precision do use momentum indicators as well. As long as you make sure that your position is always safe. So what we don't want to be doing is entering a trade, letting it run forever and ever and ever, and then letting it come back against us forever and ever and ever. What we want to be doing is either taking profit at certain levels, so we might have certain price points or certain horizontal levels that we know in advance that we want to take profit at, and that will lock in profits. Or alternatively, we might just want to trail our stop down, and that's another way of locking profit. What we don't want to do is enter a trade up here and then wait for price to come all the way back up. So yes, good question. We do need to know when to come out of that trade. Okay, let me see. I had another question. Okay, a question here. This is not really relevant to this particular webinar about trend, but I'm going to answer it anyway. The question is, when calculating pips, should I consider whole number or decimal numbers? So the answer to that, if we're looking at currencies, we're looking at the 4th decimal place as the pip. So looking at Aussie dollar right now, for example, the price is 0.6921. That 4th number is 1 pip. So if the price goes from 0.6920 to 0.6930, that would be 10 pips. And then the second part of your question, what is the safest level of pips for stop loss? That really depends on your strategy and on what time frame you're trading. If I'm trading the daily time frame, my stop loss will tend to be around about 100 pips away, depending on, again, it depends on the nature of the instrument that you're trading. Some currency pairs move a lot further in a day than others. If you're trading stocks, they may move a lot less. Gold will move a lot more. And then if you're trading down on an hourly time frame, then it may be safe. It may be safe to have your stop loss closer to price. So often when I'm trading on an hourly time frame, I might have a stop loss of 30 to 40 pips. It really depends on your strategy that you're using to trade and on the time frame that you're trading. So I can't actually give you an answer, a direct answer for what is the safest level of pips for the stop loss, because it really does depend on strategy. Bearing in mind that the closer your stop loss is to your entry price, the higher your reward to risk will be of the trade. So again, it's to do with your risk appetite as well, and whether you're more comfortable getting high reward to risk trades, but perhaps getting stopped out of more trades, or whether you're okay with slightly lower reward to risk but safer trades with a stop loss tucked a little bit further away. So good question. I'm sorry I can't give you an exact answer because there is no exact answer, but there you have it. Another question from Socky. Is there a specific number of lower highs and lower lows on a trend for it to be considered a valid downtrend and vice versa? Or does it depend on the time frame taken? The answer to that, Socky, is no. There's not a specific number. And as far as I'm concerned, is a lower high and a lower low. So for me, simply this lower high and this lower low, that's enough for me to call that a downtrend. Same here, this lower high and this lower low, that is a continuation of the downtrend. I don't need to see more than that. When we're talking about changing from a downtrend to an uptrend, let me go back to, what was it I was looking at earlier on? I can't remember now. Okay, so when we're looking at a web trend or vice versa, here I have lower highs and lower lows all down here, and then here lower highs, lower highs, lower highs, lower lows, lower lows, lower lows, and then here I start to see a higher low and I've got a higher high. So that is all I need to see in order to indicate that an uptrend has started. However, when I build in the moving averages as well, that's where I start to look for confirmation. So I've got my uptrend simply with this higher low and higher high. That is now an uptrend on this time frame. But it doesn't necessarily mean to do is look for further confirmation before I press buy, and that is where my strategy will come into play. I've got a whole tick list of things that I need to see before I will actually buy this market. Question from Sarah, can this strategy be used for gold, silver, etc.? I am not talking about or teaching you a strategy here in this webinar. The answer to that is no. This is not a strategy. I'm just talking about how to analyze and look at trend. So it's not a strategy. I'm just looking at market analysis of trend. The kind of answer to your question is yes, in that we analyze trend exactly the same way across any market. So I will analyze trend on gold, on silver, on coffee, on indices, on orange juice, any market that I trade, I analyze trend in exactly the same way, and I trade in exactly the same way, pretty much exactly the same way on those markets. So you can analyze trend in exactly the same way. Do I use fibs to confirm support and resistance positions, i.e. correlation between the support and resistance and fibs? Really good question, and the answer is yes, fibs can be really useful in analysing trend as well. It's a little bit beyond the scope of this particular webinar, but really good point there, and yes. How often in a week do I find my trend in a state of buying or selling? Good question. I trade a lot of different instruments, and a lot of different time frames. So I do regularly find trades within the trends. because I do check a lot of different timeframes and a lot of different instruments. I would say, however, that for currencies, the first quarter of this year, from kind of January through till April, was not great for trending, actually. So it really depends. How many assets would I check in a day? I do my analysis at the beginning of the week, and I have a watch list between 10 and 20 assets for each week that I focus on at that point. But at the beginning of the week, I look at pretty much everything. So I believe that that is probably all that we have time for this. I would just like to take you back very briefly to the presentation. So bear with me for a moment. Okay. So why choose ATFX? ATFX are a fantastic broker. They are the winner of Online Personal Wealth Awards 2018. They're regulated by the FCA. They have an efficient, secure, easy to use payment portal. They're committed to providing competitive prices. They have the most widely used trading platform, MT4, which is what we've just been looking at for this hour, which is a really good platform to use. And they've got a 5 days a week. So the contact details that you need if you wish to open a live account are here. There's a postal address. There is a free phone number from the UK or from outside the UK. There is a phone number there for you as well. And of course, you can reach the customer service team and the sales team at the email addresses that we have there. So thank you very much for listening today. My name's Chloe. I'm with Trade with Precision, and this webinar was brought to you by ATFX. I hope to speak to all of you at some point in the not too distant future, hopefully on another one of these webinars. So thank you very much, guys. It has been a pleasure. Have a wonderful evening.